Hi there, welcome back to another video from me. In today's video I want to dive a little bit deeper into the mess of Bayer after the Monsanto acquisition. Clearly the stock market reacted quite negatively again to another 3.3 billion provision for the RoundUp litigation settlements. But is this then this once in a multi-year opportunity to double down and buy more based on the overreaction in the stock market, or should we clearly stay away from it? I will answer both these questions today by sharing you my thoughts on the situation and the impact on their valuations. So stay tuned, but hey, don't forget to subscribe to this channel if you like this content and hit the like button. See you on the inside. Hey, before we get started, and if you're a new follower to this channel, I evaluate companies and stocks based on 6 evaluation criteria as a dividend growth investor. Today I will do it more from a valuation point of view, but I think these align really nicely with each other. So the first one that I look into is, do they have a strong catalyst or at least a really strong moat? What means, like, if you have a healthy company, a good product market mix with the products you sell, you should either have a secular growth trend that's really supporting upcoming earnings and such, or you have a strong moat, like how Warren Buffett says, it's like a strong castle, like everyone wants to attack it, but your products are so strong that it's really hard for others to do that. That's what I'm looking at here, and I'm doing that also as a first because I first want to understand, is this a healthy and a good company before I'm starting to look into the stocks. If this is already a failure, then usually I don't pass on anymore from here and I stop my analysis. It saves me a lot of time. And these 6 evaluation criteria are also done in this order so that I can stop at any moment with my analysis. So the second one that I look into then, do they have healthy earnings growth? Sales growth is important, operating margin is important, but in the end, I want to see real earnings growth. Why is that? Sometimes companies like Unilever, they spin off businesses because they were not really contributing to earnings growth anymore. So then looking to sales growth alone wouldn't give you really a clear picture. I believe it's different if you're looking at a new startup that just did an IPO. You want to see a lot of sales growth. But for these mature blue chip companies, sales growth is not usually a healthy metric to look at. You really want to look at earnings growth. And I take this from the income statement. So here I'm also starting to look at the 3 financial statements that you can expect from any company to be released according to the international accounting standards. Because the second one that I look into then is the free cash flow. I mean, it's really simple. Cash is king. A business that is not managing their cash well will be bankrupt in any time soon. So I want to see companies that are generating a lot of cash because it allows the company to return it to the shareholders, either in the form of dividends and buybacks, but also it allows it to invest again in future earnings growth. And this is also how the cash flow links back to the earnings, to the income statement. The third one then is what I look at is the balance sheet. And here I really want to see, like, is the balance sheet healthy? Doesn't it have too much debt? Does it provide the company with flexibility to do acquisitions or not? But also on the left side of the balance sheet, are there real assets behind it? Or is there, like this famous accounting topic of goodwill? Sometimes you see a balance sheet which is half populated with goodwill. Those companies are for me always at risk because they might face a lot of write-offs if the business turns to be not so well, and usually it's also a sign of overpaying for past acquisitions. So really important for me always to look at. The fifth one I look at is dividend safety. Is the dividend then safe? I look at all the things I learned from the financial statements. I look at the payout ratios then, and based on that I'll make a judgment based on the dividend safety. And last but not least, with everything I learned, and if I get this far, I start to do a fair value analysis using typically either a dividend discount model or the discounted cash flow model. And based on that, I know whether the company is also fairly priced at the moment, because I don't want to overpay for my own investments. I want to have a proper return based on the investments that I do. I want to spend my money wisely, and I don't want to pay, for instance, 50% more and then struggle with proper growth of my portfolio in the future. So that's why the fair value is for me really important. On companies that are a little bit in trouble, I want to see a discount, a margin of safety. On really strong companies that are hitting the numbers every time, there's nothing that you can say against it. I'm able to buy at fair value. So this is also how I will look at Bayer today. I might not do the full business analysis and all the 3 financial statements in depth. I will highlight some of the things that I observed after the Monsanto acquisition. Dividend safety is not really relevant here because they cut the dividend already last year from €2.80 to €2, but I will spend some time on the fair valuation. So if you're not familiar with Bayer yet, Bayer is really one of those big European companies, probably one of the bigger ones that we know in Europe, and it's operating in the pharmaceutical industry. One of their biggest selling products, or their biggest selling products, is Xarelto, which is a blood thinner effectively. So many people with blood clutter use this, and their sales was approximately in the first half around 2 billion, which is huge, and it's I think the second best-selling drugs is on the second place with half of that in sales, but it's also big in the consumer health, and that's where most of you will probably know it from because it has the famous brand aspirin for when you have a little headache, but also Bepantem. If you're a young parent, you probably use it for if your children have issues with their skin, you put it on it, usually the day after it's fixed. Really strong products and good products. But the third business unit where it earns a lot of money is the crop science, and this is also why we're really talking about Bayer today, because it got into trouble with the acquisition of Monsanto. So one of the products in here is RoundUp, and this is what we will be touching on quite a little bit now. So let's go back then to when the Monsanto acquisition actually happened, because this is why Bayer is in trouble nowadays. So this happened in September 2016. The company announced the acquisition of Monsanto for $128 per share in an all-cash transaction, which was at that time a 44% premium on the price, which means these 44% on the premium on the price, and probably more related to the assets as well, will all go into the goodwill part of the acquisition. And remember that if we judge management on their performance, they usually do write-offs and keep it out of the earnings going forward, because they say these are one-off write-offs. Those are usually write-offs based on the decisions made here today, for which they got handsomely rewarded, because what they will write off on typically is writing off on goodwill. Goodwill is just the price they overpaid for it. So keep that in mind also when you're looking generally at companies that are distincting between GAAP earnings and non-GAAP earnings, and specifically when they make write-offs based on the new fair value assessment of their goodwill. Anyway, that aside, what they were expecting, and this is really what is important here, they were expecting at the announcement of the deal a synergy of approximately $1.5 billion after year 3. On an annual basis. What is important here to mention is that currently the litigations regarding RoundUp and the settlement that Bayer is accounting for is already more than 13 billion. So already 8 or 9 years of synergies is down the drain. Usually you do a fair value analysis of a company on 10 years. So based on this, the whole acquisition, everything they expected is already gone. So synergies gone. They're already gone with the settlements. And we can even talk more about what they wanted to expect with EPS and such, but it shows you just the opportunistic behavior at the time of the acquisition, and this was in 2016. What is also important, they could get away from this for 2 billion. So they had at the time, they could get away from, in general, from Monsanto. If the merger would collapse, they could get out of it for 2 billion. So keep that in mind as well. At the time, Bayer in September was trading around 85, 80 euros or something like that. I bought it in the high 70s, I think back in 2015 or something like that, or maybe even here earlier on in 2016. And you see where it is now, by the way, it's now at 47 euro. So then on June 7, 2018, Bayer announced that they closed the Monsanto acquisition, so it took them 1.5 years or something like that, even more. Also at the same time, they had to sell 9 billion some assets to BASF. So BASF was a happy receiver here. And this had all to do with the regulators that were afraid that Bayer would have too much market dominance with the combination of Monsanto and the existing agricultural business. So that's why they had to sell it to Bayer. I'm also to BASF. I'm also a BASF shareholder since recently, so at least I received the assets on the other side. But if we then start looking at it, remember it was June. In August 2018, literally 1.5 to 2 months later, the first Monsanto lawsuit was being, the verdict was in there for 289 million. And what stunned me at the time already, that there were 5,000 similar lawsuits expected. So just keep that in mind, right? Because we were talking here about June when they announced it, and I just mentioned about the 2 billion. If they would have done the math already at the time, they could still get out of it. I'm sure that 2 months before they would have had done a proper risk assessment of this. And if they haven't, then it's just plain stupid. But just in 1.5, 2 months after the finalization of the acquisition, they could have called it. They could have stepped out for 2 billion. They didn't, and now they have 13 billion in settlements. Just remember that this is the same management that made all these decisions here. It's not an easy case, by the way, and to be fair to management as well, but generally the science so far, based on the reviews published by Bayer and by the Environmental Protection Agency, there's no clear linkage yet between glyphosate and cancer as such. So this is important to know. America has a jury system, so that might be influenced by the negativity, the brand negativity around Monsanto and such. So still the verdict is out on this, and it's now getting to the Supreme Court here. So, and this maybe then also to fast forward to today, because on July 29th, Bayer came with a plan. They announced, oh, and by the way, based on the 10 billion from last year, we will need to settle for another another 3.5 billion for settlements, but we have a plan. So what's their plan? They are going to effectively administrate all the settlements themselves, and that's really what they want to do, and not have a one-off settlement for all the cases as such. I think it was also almost impossible for them to do. They will be fighting it in the Supreme Court as well, so they will continue appealing also to all the verdicts so far. And I said they also want to go in to have a conversation with the industry about preventing RoundUp being used for personal use for us at home, effectively in our gardens. How does it look like then? Here you see the scenario 1 and 2 that they referred to. In scenario 1, when it's favorable with the Supreme Court, then we're good. Yeah, it's all done. We'll be all happy. No settlements, they can keep the money in the pocket. If there is something there could be still favorable outcome, but in the case it's not favorable, they need the 13 billion to start paying the settlements. So this is where we are today when it comes to the litigation. What I want to show you also a little bit now the numbers as how it has been, how this Monsanto acquisition has been going over time. So they acquired the assets. You don't see it really in revenue here because there was a lot of overpayment. It was not necessarily adding to the revenue. You can also see that really didn't impact the cash flow. So if you wouldn't know better, you wouldn't know based on these numbers that they acquired a company at all. Where you can see it, though, it's in their debt to equity ratios, which shot up in 2018, 2019, and 2020. So remember what they were saying, double-digit growth in their numbers. You cannot see it back over the last several years. If we go then to their financials, it's a similar story here. In their balance sheet, you can see a clear increase of goodwill, as an example. It went from 14.7 billion to 38 billion in 2018, and also their liabilities went up from around 12 billion to 37 billion. Since then, they have been using some of the cash flow though to pay it off. So it's not like totally poor management from there onwards, but this litigation is all the time hovering over it. What is concerning, though, that what you can see here is over the last year, especially also the shareholders' equity has been really decreasing. So that makes the debt to equity ratio really poorly at the moment. From a cash flow point of view, actually, if we go there, it was a really well-running business from a free cash flow point of view. You can see here, back in 2016, it was still making 6.5 billion in free cash flow, all the time about 5 billion. But when they had to settle the 10 billion in free cash flow, and now the another 3 billion, you see that the free cash flow is even negative over the last trailing 12 months. So what we will do soon, we will look at the at the fair value analysis. We can play a little bit with these numbers around free cash flow to see what the company is currently worth. So last but not least, what I wanted to share with you is that also in the at the time of the acquisition, they were saying that with the Monsanto acquisition, they are aiming for an A rating. But at the moment, they have from Moody's a Baa2. Just as a reminder, it means it's a lower medium investment grade. I totally understand it when looking at the balance sheet deterioration that we have been seeing. Their aim is to be around the A1, A2. They are far away from that. I don't see it happening in the upcoming few years, as long as they don't win the court case and get a favorable ruling. Okay, so let's look then also a little bit at the earnings. I can tell you the earnings were generally good over the last half year, although their sales were flat. It's a difficult environment in the pandemic, post-pandemic. Generally, you could say that their core earnings have been flat, 1,559, 161, or in the first quarter, so not much change there. Core earnings really means if we leave out the settlements and the other one-offs here. I think it's a little bit fairer to do this because we know about these settlements, we will model with it, so their real earnings power is around €6 on a yearly basis. If you look at the current price of 47, it gives you a PE of 7 to 8 or something like that. Okay, so now that we know that the earnings were quite okay in itself, we know that the balance sheet really doesn't look good compared to how it was looking in the past. So let's just see, is this a great turnaround story? It's obvious for me. It's not a dividend growth story here. So I'm not looking at this as a dividend investor because their dividends last year were €2.80. Then over 2020, it was €2. So the dividends were in decline. It might be even cut further based on what we are seeing here. But having said that, is this a turnaround story? Will this give us a 2 or a 3 bagger over the next 2 years? Let's have a look at that. So what you see in front of you here is my discounted cash flow template, and it consists of few variables. The variables here are highlighted in yellow and are important to model into the template. And the most important for me here is the free cash flow that we are assuming and the growth rates that we are assuming and our expected returns that we are assuming. So remember what I showed you before. There was a bottom floor of 5 billion in cash flow on an annual basis before shit hit the fan at Monsanto with the Monsanto acquisition. So let's assume that they settle everything, and let's assume based on that those are now behind us, those settlements. So the 13 billion, it's in the numbers, and going forward they will have an annual free cash flow of 5 billion. Let's assume that. We also model with their current cash on hand that I took from the balance sheet, which is around 6.5 billion at the time of this video. My baseline case is that the growth rate for them in the upcoming 5 years is around 6% on an annual basis. The company is also having a forward outlook around regarding this. After that, I assume a little bit less growth and around 4%. We can take a discount rate here, so the cost of capital of around 6%. I'm using that here now, but I will later change this because together with the free cash flow assumption and the discount rate assumptions, those are the biggest, variables that you need to feel comfortable with because they have the highest impact in the fair value assessment of the price. Under normal circumstances, a company like this with such a history of the Monsanto acquisition, it's behind them. People will not be fully confident. I believe it needs to trade at a multiple of 15. I give this a probability of 70%. In the optimistic case though, buyer really leaves everything behind, starts growing rapidly, discovers a new drug, more favorable brand recognition in their agricultural business. So they start growing with 10%. You know, the world needs more food. They invent new drugs as well, 10% growth rate. And after that, after 5 years, 5% growth rate. In that case, I think it deserves a multiple of 20. In the bearish case, they keep on struggling, but they have still decent growth of 5%. After that with 2%. But I would say in such a case, it deserves a multiple of 10. At the same time, in the baseline case, I'm also adding, again, additional litigation charges because, you know, it was still a little bit more expensive than management expected. So let's add another 3 billion there. And in the worst case, they need to add another 7 billion and total comes to 20 billion of litigation. Based on these numbers, the fair value of the baseline case will be around €96 for buyer. That's 2 times more than it currently trades for. These are not high numbers here, but what I want you to know is that the discount rate is low because we live in a low interest environment at the moment. In the optimistic case, we're talking about 147 euro. That we're talking about 3 times the money it currently trades for. This is really huge. In the bearish case, you could still argue that the company is at the moment fairly valued. But hey, for a company like Bayer in this case, yeah, I want to see more. I need a higher discount rate because it doesn't adjust for the risk that I'm taking here. 6% is nice for the cost of capital, but maybe the interest rates will go up. But you can also look at it from what is the return that I need? Yeah, how much return do I want out of this company? So let's model it with 10%. And let's do that for all 3 cases. In that situation, you will see that the fair value went back significantly to 63 euro in the current case. Still a nice margin of safety on the current price. We're talking about more than 20% margin of safety here. In the optimistic case, 100, but in the bearish case, it starts to look bad now because we're looking at 31 euro here. So remember, I would need from this company at least a 10% rate on return, excluding the dividends here. But what if the free cash flow would not be so high, or not return to normal, but it would stay around, I don't know, at 3 billion? What are we looking at then? At 3 billion, you can clearly see that the company under normal circumstances is highly overvalued, around 26 euro. 49 euro would be an optimistic case if it's able to grow with 10%, but it would be almost towards zero. And why would it be always towards zero? Because you look at the terminal value, will be 38 billion for the company, but you need to deduct all the long-term debt as well. I'm always taking the debt out of my fair value and intrinsic valuation because it doesn't it doesn't belong to me as a shareholder. Having said that, what do I think is realistic? I really think it's realistic that we will see a floor of 5 billion in free cash flow from a company like Bayer once they come into a little bit more stable waters again. However, I do want to see a discount rate of 10%. So all in all, with that having said, I believe that the company is then fairly valued at around 64 euro. And with a margin of safety, assuming I might be wrong, for instance, my free cash flow is too high, I believe that the buy price is around 51 euro. So at the moment, it tells me it's investable. There's more fear in the market than it probably deserves. I really dislike management. I hope that they will replace the CEO anytime soon. For me, it's really incompetent if you see about how the whole Monsanto acquisition went, which he had a large part in, or actually he has been totally accountable for. So for now, I will hold on to my shares because from an opportunity cost of view, the market is expensive. If this company get a favorable ruling, this price could grow really quickly, bump up to 100 euros on no time, because then also the debt figures and such will not need to be so high. The provisions can be rolled back. So from that point of view, it will look much better. So I'm hanging on to it, not with a lot of joy, but it's too cheap for me now to throw it away effectively. So that's my assessment of the Bayer case. It's really awkward for me because I really dislike management at the moment, but you know, the numbers are just too good. They bought a cat in the bag, but for now I'm staying on to it. I might sell it if it hits 65 or something like that, put a wrapper around it for myself and sell it and get rid of it. But I will now move it into my 10% part of my portfolio, which I use for investing in tech stocks or value plays. This is not for me a dividend growth stock anymore. So I hope you enjoyed this video. I hope I brought some clarity to all the noise that you see around Bayer. I hope you found it informative. I hope it took some fear away from you from what you read all in the headlines. I've presented you some of the cold facts today as how I know them as facts. And yeah, I leave it up to you to make wise investment decisions. Of course, do your own due diligence. I'm not a financial advisor. I'm just a person who is self-taught in this and loves to talk about investing. But I might be totally wrong. It's your money, not my money. So please invest with caution. See you next Sunday.